They didn't ban you. They didn't announce anything on the news. They didn't change the law. But overnight, while you were sleeping, they changed the game, $52,000. That is now the price just to stay in silver. Not to buy it, not to own it, just to survive it. And here's the part they don't want you to connect. While your screen shows one price, the real world is trading at another, a gap so dangerous, so unnatural. That in every other market in history, it only appeared right before something broke. And what I'm about to show you next is the exact signal that appears just before the exit doors are quietly locked. Welcome to Market Metal, where we don't chase headlines, we follow the metal, the data, and the moves nobody explains. And before we go any further, if you're someone who's lived long enough to see housing booms, stock crashes, currency games, and promises broken more than once, then you already understand something younger people are still learning. So do me a favor, subscribe to Market Metal the way you'd mark a newspaper you trust, not because of hype, but because you know information is protection. Also, I'd love to know, where are you watching from right now? Tell me your country in the comments. Let's begin. The structural shift. When a market stops behaving like a market. For most of modern financial history, markets have followed a familiar pattern. Prices rise and fall. Volatility comes and goes. Traders win and lose. But beneath all of that movement, the rules of participation remain mostly stable. The cost of entry changes slowly. Risk controls adjust gradually. And when they do change, the reasons are usually clear and widely understood. What happened in the silver market did not follow that pattern. In less than 1 month, the cost to hold a silver futures contract was pushed from around $20,000 to nearly $52,000. Not over a year, not over a cycle, over weeks. And it happened quietly. No emergency broadcast, no front page headlines, just a series of technical notices that most people never read. On the surface, it looked like routine exchange maintenance, a margin update, a volatility adjustment, the kind of thing that happens from time to time. But when analysts who follow market structure closely examined the pace, the scale, and the timing, it became clear this was not routine. This was not a market reacting. This was a system intervening. To understand why this matters, one must first understand what margins are supposed to do. In futures markets, a margin is not a down payment. It is a performance bond. It is money posted to ensure that both sides of a trade can survive daily price swings. Its purpose is stability, not control, not punishment. Stability. Under normal conditions, margins rise when volatility rises, but they rise gradually. They move in proportion to actual daily risk, and they are adjusted in ways that still allow broad participation. That is not what happened in silver. The margin requirement was not gently lifted. It was escalated, repeatedly, in rapid succession. And finally, it was restructured entirely into a percentage-based system that increases automatically as the price rises. This distinction matters. A fixed margin can be absorbed. A percentage margin compounds pressure. Under the new structure, every upward move in silver automatically increases the cash required to hold the same position. The market no longer merely tests conviction. It continuously drains liquidity from one side of the trade. This transforms margin from a risk tool into a participation filter. And participation filters are never neutral. At nearly $52,000 per contract, the silver futures market effectively changed who is allowed to remain. Independent traders, small funds, business owners, entrepreneurs, hedgers. They now face a capital threshold that is no longer related to silver itself, but to their ability to post idle cash. Meanwhile, large institutions operate under a different reality. They access internal financing. They net positions. They fund margins from balance sheets rather than bank accounts. For them, margin inflation is inconvenient. For others, it is disqualifying. This is how markets quietly change hands. When the cost of staying exceeds the logic of staying, positions are not closed by choice. They are closed by force. In traditional market cycles, forced selling happens when price collapses. Here, forced selling was engineered through policy before any collapse occurred. That inversion is important. It suggests that price was not the risk. Exposure was. There's a reason exchanges intervene aggressively only in certain moments. Not when markets are balanced, not when risk is evenly distributed, but when positioning becomes asymmetric, when too much exposure accumulates on one side, when losses concentrate instead of disperse. At that point, the problem is no longer price, it is counterparty. And counterparty risk is not solved by charts. It is solved by removing participants. The speed of the silver margin increases, signaled urgency. The shift to percentage-based margins signaled expectation. The scale signaled necessity. Systems do not redesign their control mechanisms unless existing ones are failing. This was not a warning to traders. It was a defensive maneuver by infrastructure. History provides a consistent lesson on this point. Exchanges raise margins aggressively only when the clearing process itself begins to strain. when the system becomes less concerned with speculation and more concerned with survival. At that stage, the market stops behaving like a market. It begins behaving like a containment zone. Containment zones are designed to limit movement, to reduce flows, to prevent accumulation, to slow reactions, and most importantly, to protect the structure from those using it. This is why the language around margin changes is always technical, because technical language discourages attention, it frames policy as mechanics, it avoids interpretation. But markets are not mechanical systems, they are financial ecosystems, and when ecosystems alter entry conditions abruptly, it is never random. It reflects internal imbalance. In the silver market, the imbalance was not volatility. Volatility can be absorbed. It was positioning, and positioning cannot be erased without forcing someone out. The $52,000 margin did not simply make silver more expensive to trade, it redefined who silver is for. When an asset becomes too costly to hold without leverage, and leverage becomes too costly to maintain, the market stops being a price discovery venue and becomes a liquidity sorting mechanism. Those with excess capital remain. Those without are removed. This is not theory, it is arithmetic. Every margin hike is a test. The first removes the weakest participants, the second removes the resilient, the third removes the disciplined. What remains are entities whose survival does not depend on price direction, but on capital depth. At that point, the market is no longer shaped by expectation. It is shaped by capacity. This is how financial structures quietly reset without official declarations. They do not outlaw participation, they price it out. And they do it precisely when participation becomes dangerous. Part 1 establishes a simple reality. The silver market did not just change price, it changed structure. And when markets change structure, outcomes change before headlines do. What that structure is responding to, and why silver required it while most other markets did not, is where the real story begins. The price. That no longer exists. For decades, the global silver market operated on a simple belief. There was one price. It did not matter whether silver was bought in New York, London, Shanghai, or Dubai. Screens around the world displayed the same number. Contracts, vaults, refiners, jewelers, and manufacturers all anchored their decisions to it. That single figure was not just a quote, it was trust. Trust that an ounce of silver was an ounce of silver. Trust that paper claims and physical metal were interchangeable. Trust that the system connecting them was real. That belief has now fractured. What first drew attention was not a collapse. It was a spread. While futures markets continued printing prices near $115 per ounce, physical buyers in Asia and the Middle East were quietly paying far more. In Shanghai, physical bars were trading above 130. In Tokyo, near 140. In Dubai, around 130. At first, these looked like regional distortions, logistics, taxes, temporary demand spikes, but distortions close. These did not. They widened. And they did so across multiple independent markets at the same time. In functioning commodity systems, such gaps cannot survive. When physical prices rise above futures, arbitrage capital moves in. Traders sell physical into the higher priced region and hedge on the exchange. The spread collapses. Balance is restored. That mechanism did not activate, which meant something essential was missing. Either physical silver could not be sourced in sufficient volume, or futures contracts could no longer be relied upon to deliver it. Both interpretations lead to the same conclusion. The screen price was no longer clearing the market. When that happens, a commodity ceases to be priced. It begins to be rationed. This is the moment markets attempt to hide. Because price discovery is public, rationing is not. Rationing appears as premiums, as delays, as sourcing fees, as regional exceptions, as logistics problems, as refinery bottlenecks, as inventory adjustments, as temporary dislocations. But when they appear everywhere at once, they are not temporary. They are systemic. Silver began showing that signature. Industrial users were not bidding futures higher. They were bypassing them. They were going directly to the physical channels. Direct procurement, direct contracts, direct sourcing. This behavior reveals something critical about confidence. Markets only bypass pricing systems when they no longer trust them. Trust does not vanish because of headlines. It vanishes when contracts stop solving problems. And futures contracts exist for only one purpose: to guarantee future metal. When buyers stop believing they can obtain metal through paper, paper loses authority. And when paper loses authority, its price becomes symbolic. The divergence between future silver and physical silver was not merely a premium. It was an admission that two markets were now operating. One that trades exposure and one that trades supply. The first is fast, the second is real. Two-tier markets are not born from speculation. They are born from scarcity. Every historical two-tier system followed the same sequence: paper stability, physical tightness, delivery delays, premium expansion, confidence erosion, direct sourcing, finally price abandonment. Silver was now at stage 3. The premiums were no longer isolated, they were synchronized. And synchronization in physical commodities signals only one condition: global strain. What made this divergence more alarming was not the numbers themselves, it was who was paying them. Not collectors, not small investors, but industrial buyers. Entities that do not speculate, they consume, they manufacture, they require delivery. Their tolerance for paying above screen prices is not ideological. It is operational. They pay more only when supply risk exceeds price risk. And when operational buyers stop anchoring to futures markets lose their reference. They become financial venues, not commodity venues. This is the dividing line. A commodity market functions only while it sets the cost of obtaining the commodity. The moment it fails to do that, it becomes a derivative theater, disconnected from procurement, disconnected from logistics, disconnected from production, and ultimately disconnected from relevance. Silver began drifting toward that line. The spread between physical and paper prices was not merely signaling demand, it was revealing fear. Fear that future delivery might not occur on schedule, fear that inventories might not be accessible when needed, fear that clearing prices might not represent replacement cost. These are not retail fears, these are procurement fears. And procurement fear is the deepest kind, because factories do not fear price, they fear absence. The silence surrounding this divergence was also telling. Major financial outlets did not analyze it. They reported price, not procurement, charts, not contracts, futures, not freight. Because acknowledging a persistent premium forces a dangerous question. If the quoted price cannot buy metal, what is it pricing? The moment that question enters public thought, the authority of the entire pricing system is threatened. This is why two-tier markets are always minimized until they cannot be. By the time they are openly discussed, the migration has already occurred. Silver's migration was underway, not through announcements, through behavior, through who was buying, where they were buying, and what they were willing to pay to bypass the screen. Once that behavior spreads, futures markets face an existential dilemma. Either prices rise to meet physical reality, or physical markets permanently decouple. Both outcomes represent failure of control. One violently, one quietly. The divergence visible in silver did not signal excitement. It signaled disobedience, and markets only disobey when they no longer believe. What silver was showing was not enthusiasm. It was exit. Exit from a pricing system. Exit from an assurance mechanism. Exit from a paper promise. And exits do not announce themselves. They appear first as small premiums, then as stubborn ones, then as permanent ones. By the time they become headlines, the structure has already shifted. Silver's price no longer existed. There were now two, and history is clear on what happens next. One of them disappears. The metal is leaving markets usually break loudly. Stocks crash, prices gap, headlines explode, but commodity systems fail differently. They fail quietly. They fail when metal starts leaving and does not come back. Long before price reflects stress, inventory does. Vaults speak before charts. And in the silver market, the vaults have been speaking. They have been emptying. At first, the withdrawals looked ordinary. Daily flows. Routine shipments, normal activity. Silver moves constantly between refineries, fabricators, exchanges, and manufacturers. But then the pace changed. And then the destinations changed. And then the months changed. Silver began leaving registered exchange inventories in volumes that no longer matched normal industrial cycles. Tens of millions of ounces moved out in weeks, not rotated, not transferred, withdrawn. Registered inventory is not theoretical. It is the metal that has been declared available for delivery against futures contracts. It is the final buffer between paper claims and physical settlement. When that buffer shrinks slowly, it is management. When it shrinks quickly, it is stress. And when it shrinks while delivery requests rise, it is pressure. That is what silver began to show. January is not supposed to matter. In futures markets, demand follows calendars. Primary delivery months carry the weight. Secondary months remain quiet. They function mostly as financial bridges between major settlement periods. January is one of those quiet months, or it was. Instead, January emerged as one of the largest silver delivery months in history, not because of headlines, not because of speculation, but because contracts were being converted into claims, and claims were being converted into metal. This distinction is essential. Most futures contracts are never settled with physical delivery. They are rolled, closed, offset, replaced. They represent exposure, not acquisition. When contracts are suddenly allowed to mature into delivery in large numbers, it signals a shift in motive. Participants are no longer satisfied with price exposure. They want the asset. That transformation changes everything. Because exchanges are designed to process paper, not evacuations. Large delivery volumes do not merely drain metal. They drain time. They compress logistics. They stress refineries. They disrupt allocation schedules. And most critically, they concentrate counterparty risk. The silver exchange system was built on a ratio, a ratio between the metal that exists and the claims written against it. That ratio only works when few people request what they technically own. The moment that changes, the system must choose between rationing and reputation, and systems always choose survival. What made this delivery surge more unsettling was not its scale alone, it was its participants. Major financial institutions were not absorbing deliveries, they were issuing them. They were releasing metal, delivering metal, reducing exposure. When institutions that historically warehouse and mobilize metal begin pushing it out of the system, they are not making a trade. They are changing posture. They are not expressing an opinion. They are adjusting risk. And institutional risk adjustments occur only when internal metrics cross thresholds. Metrics not visible to charts. Metrics related to availability, to coverage, to replacement, to forward access, to settlement confidence. This behavior was synchronized with something else, rising lease rates. In commodity markets, lease rates measure the cost to temporarily borrow physical metal. They remain low when supply is abundant. They rise when metal becomes difficult to source. They spike when holders no longer want to lend. Silver lease rates began climbing into ranges rarely seen outside crisis periods. This signaled that even institutions were struggling to source metal without paying premiums. And when leasing becomes expensive, it reveals a more dangerous reality. It means metal is no longer sitting idle. It is spoken for, allocated, committed, consumed. The system's flexibility disappears. At the same time, the futures curve began displaying signs of backwardation. This is a technical condition where immediate delivery costs more than future delivery. In stable markets, future prices are higher. They account for storage, insurance, and time. When spot becomes more expensive than future contracts, it reflects urgency. It means buyers are willing to pay more now than later, because later is uncertain. Backwardation is not a pricing anomaly. It is a warning. It indicates that the system values possession over promises, that holders will not part with metal unless compensated immediately, that contracts dated months out are no longer trusted to fulfill physical needs. These conditions rarely appear together, and when they do, they precede only one environment: shortage. Not narrative shortage, operational shortage, the kind that disrupts supply chains, the kind that forces manufacturers to renegotiate contracts, the kind that compels governments to prioritize allocation, the kind that drives exchanges to alter rules. And suddenly, the margin escalation from part one becomes easier to interpret. It no longer looks preventative, it looks responsive. When delivery requests rise, when inventories drain, when lease rates spike, when futures curves invert, when institutions deliver instead of accumulate, exchanges do not protect traders. They protect continuity. And continuity depends on controlling how many claims can be exercised. This is where silver was drifting, toward a settlement environment where the problem was no longer price. It was fulfillment. Every ounce withdrawn from registered inventory reduces the system's ability to honor its contracts. Every contract converted to delivery accelerates that reduction. And every policy change that removes participants reduces the probability of further conversion. This is why margin is raised, not because volatility threatens traders, because delivery threatens the system. Markets can survive collapsing prices. They cannot survive collapsing credibility. What silver was experiencing was not enthusiasm. It was extraction. An extraction from an exchange is not bullish. It is terminal. When metal leaves faster than it returns, the structure no longer governs trade. It manages depletion. At that stage, outcomes are no longer determined by sentiment. They are determined by arithmetic. And arithmetic does not negotiate. It resolves. The elimination phase. Every financial system has a final defense. It is not regulation. It is not communication. It is not even intervention. It is exclusion. When a market can no longer balance claims with reality, it does not correct itself. It restructures who is allowed to participate. And it does so using the only lever it fully controls: access. In silver, that lever became margin, not quietly, not slowly, but decisively. A silver futures contract represents 5,000 ounces. At prices above $100 per ounce, each contract controls more than $500,000 worth of metal. Under normal futures conditions, only a fraction of that value must be posted as collateral. This allows businesses, producers, refiners, and traders to hedge, plan, and allocate capital efficiently. But under the new structure, nearly $52,000 must be posted in cash simply to remain in the position. Not to acquire silver, not to take delivery, only to stay. And this cash must sit idle. It cannot be invested. It cannot be deployed. It cannot be protected. It exists only to defend a position against a system that has declared that holding silver exposure is now a high-risk behavior. This reframes the market entirely. Silver futures are no longer instruments of planning. They are tests of endurance. When margin requirements reach this scale, participation ceases to be about conviction. It becomes about spare liquidity. The market stops selecting for insight. It selects for balance sheet depth. This is the elimination phase. In the elimination phase, Outcomes are not shaped by who is right. They are shaped by who can remain. The shift to percentage-based margins intensified this mechanism. Under this model, margin is no longer a fixed hurdle. It is a moving barrier. Every increase in price automatically increases the cash required to hold the same exposure. This ensures that the higher silver rises, the more capital is drained from those betting on its rise. This creates a structural contradiction. A rising price should reward holders. Instead, it now taxes them. As silver advances, more capital is pulled from longs, not less. The system mechanically converts upward movement into stress. Stress produces liquidations. Liquidations produce selling. Selling applies pressure. Pressure suppresses price. This is not a side effect. It is design. This is how markets are slowed without being halted. This is how rallies are fragmented without being banned. This is how participants are removed without announcements. Each margin hike forces a calculation. Can the position still be justified? Not economically, but logistically. How much idle cash can be sacrificed to remain exposed? How long can that sacrifice continue? What is the opportunity cost of staying? These questions have nothing to do with silver's supply, silver's demand, or silver's value. They relate only to survival inside a constrained system. And survival is not evenly distributed. Large institutions do not experience margin the same way. They fund positions through internal pools. They offset exposures across books. They meet collateral demands through structured finance rather than cash transfer. For them, margin is accounting. For others, it is withdrawal. This asymmetry defines every elimination phase in market history. When policy tools are deployed, they do not level conditions. They concentrate them. As conditions tighten, the market's composition changes. First, short-term traders disappear, then leveraged funds, then commercial participants, then disciplined operators. What remains are entities whose time horizon is unlimited and whose funding is institutional. At that point, the market ceases to represent participants. It represents capital classes. This is where outcomes are engineered. When participation narrows, volatility becomes easier to direct. When exposure concentrates, price becomes easier to influence. When access is restricted, control returns. This is why elimination phases are never framed honestly. They are described as risk management, as stability measures, as protection. But protection of whom is never clarified, because it cannot be. In silver, the new margin regime did not protect producers. It did not protect industrial buyers. It did not protect long-term holders. It protected the system that intermediates between them, and that system was facing a problem that margin could solve: delivery pressure. By raising the cost of holding futures, the system discourages new long positions. By draining capital from existing ones, it accelerates their closure. By reducing open interest, it reduces the number of claims that can mature. By reducing potential maturities, it reduces delivery risk. This is not speculation. It is settlement mathematics. The fewer claims exist, the fewer can be exercised. The fewer exercised, the longer inventories last. The longer inventories last, the more time the system buys. Time is the objective, not price, not fairness. Time. Time to source metal. Time to redirect flows. Time to renegotiate contracts. Time to restructure exposure. Time to reestablish control. This is why margin was not adjusted once. It was escalated. Because the system was not addressing volatility, it was responding to depletion. The silver market's behavior revealed that the threat was not price movement. It was convergence. Convergence between paper claims and physical demand. And convergence is dangerous to leverage structures, because leverage only survives while redemption remains rare. Once redemption becomes common, leverage becomes fatal. This is why elimination always precedes either repricing or separation. Either futures prices rise to match physical reality, or futures markets lose authority entirely. In both cases, the system as it existed dissolves, but before that happens, there is always an attempt to thin the field, to remove as many participants as possible, to ensure that whatever follows affects fewer claimants. This is not collapse, it is compression. The silver market was being compressed, not in headlines, in infrastructure, in policy, in collateral, in access, in who is allowed to stay. This is how financial endings begin. Not with crashes, with quiet doors, with rising thresholds, with technical bulletins, with invisible exits. By the time prices move violently, the story has already happened. The positions have already changed hands. The metal has already moved. The system has already decided who remains. Silver was no longer merely trading, it was filtering. And filtered markets do not resolve gradually, they resolve decisively. Because once exclusion replaces participation, the market no longer belongs to the many, it belongs to whoever can outlast the structure. And structures only favor those who built them.